The United States isn't drowning in debt. It's already past that point. $37 trillion, a number so large it exceeds the entire global economic output of the early 2000s. And here's the part almost nobody understands. Washington isn't preparing to repay a cent of it. They're preparing to erase it, not through default, not by slashing budgets, not by squeezing taxpayers harder. The strategy is far more elegant and far more dangerous. It's called controlled devaluation, a deliberate, engineered erosion of the dollar's purchasing power so slow and so technical, most Americans won't recognize what's happening until the math is irreversible. And the tools they're using are the last assets anyone expects the government to weaponize: crypto and gold. Right now, behind press releases about innovation, digital leadership, and strategic reserves, the U.S. is assembling the architecture of the most sophisticated debt reduction mechanism in modern history, a parallel financial system designed to rewrite the value of the country's own balance sheet. When hard assets are revalued upward, the dollar is pushed downward. When the dollar falls, dollar-denominated debt shrinks in real terms. And when the debt shrinks, the government wins, while every saver, retiree, and dollar holder pays for it without ever seeing a tax bill. In this investigation, I'll show you exactly how this works, step by step. Starting with the fundamental truth most people get wrong about government debt. Most people think national debt works like personal debt. You borrow, you repay, you cut spending if you have to. But a government doesn't operate inside that box. It controls the currency the debt is denominated in. And when you control the currency, you control the rules. Washington doesn't need to work more, sell assets, or tighten its belt. It can simply redefine what a dollar is worth. It can shift the value of the assets it holds. It can shrink the real weight of its obligations without paying them off. Not through accounting tricks, but through monetary engineering. This process has a name, a currency reset. And it's not theoretical. It's not new. It has happened before, openly, legally, and with devastating precision. To understand what's unfolding right now, you need to see the blueprint the U.S. used the last time it faced an impossible debt problem. To understand what's coming, look at what already happened. The U.S. government has pulled this off before, openly, legally, and with breathtaking precision. In 1933, America was suffocating under the weight of World War I debt and a collapsing economy. Deflation was crushing wages. Banks were failing. Debt to GDP was spiraling. The government had no way out, at least not through conventional means. So Roosevelt did something no one believed a democratic nation would dare to attempt. He changed the value of money itself. First came Executive Order 6102, a mandate requiring Americans to surrender their gold to the federal government, not voluntarily, not as a patriotic gesture, by law. Citizens were compensated at the official price, $20.67 per ounce, a number untouched for more than half a century. Most people complied. They handed over their coins, bars, and savings, the very foundation of the dollar. Then came the pivot. Once the gold was secured, the government repriced it. In 1934, the official valuation jumped to $35 per ounce, a stunning 69% increase overnight. That single act created billions in new balance sheet value for Washington. The gold they confiscated from citizens was suddenly worth almost two-thirds more. Government debt, denominated in dollars, became cheaper in real terms, and inflation over the following years quietly erased even more of the burden. Meanwhile, ordinary Americans paid the price. Their surrendered gold soared in value, but it was illegal to buy it back. Their dollars bought less. Their savings shrank in real terms. This wasn't a minor policy tweak. It was a monetary reset, and it worked exactly as intended. And today, the U.S. faces a debt crisis far larger and far more dangerous than the one Roosevelt confronted. If 1933 was a financial emergency, then today is a mathematical impossibility. The United States doesn't just have a debt problem. It has a debt structure that no economic growth rate, no tax reform, and no spending cuts can realistically fix. The number is $37 trillion, but the number itself isn't even the real threat. It's the trajectory. Debt to GDP has climbed to 132%, higher than at any point in U.S. history outside of total war. And unlike World War II, there's no industrial boom waiting on the other side. The annual interest alone, not principal, just interest, is now over $1.2 trillion and heading toward $1.8 trillion within just a few years if rates stay where they are. That's more than defense, more than Medicare, more than anything except Social Security. You can't tax your way out when interest consumes the budget. You can't cut your way out when debt grows faster than the economy. And you can't inflate your way out without detonating the dollar in full view of the world. Washington knows this. The Federal Reserve knows this. Treasury knows this, which is why they're turning to the same solution Roosevelt used, but this time with tools he could never have imagined. A reset built not only on gold, but on digital hard assets the government has quietly begun assembling. When a government reaches a point where traditional economics can't save it, it doesn't announce a new plan. It changes the battlefield. And right now, the US is quietly building the most unusual reserve position in its history, one that has nothing to do with oil, steel, or foreign currency. It's Bitcoin. In early 2025, the White House signed an executive directive establishing a strategic Bitcoin reserve, framed as innovation, competitiveness, and ensuring U.S. leadership in digital assets. That's the public explanation. The real objective is accumulation. The U.S. already controls roughly 210,000 Bitcoin, mostly seized from criminal cases, Silk Road, ransomware networks, exchange hacks. But that's the starting point, not the endgame. A proposal now circulating in Congress outlines a target of 1 million Bitcoin over the next several years, a number large enough to influence global pricing and small enough to accumulate without triggering panic. But here's the part most people miss. They're not buying it in the open market. They're pulling it in through seizures, through fines, through settlements with crypto companies, through energy infrastructure that can be redirected toward mining, through quiet custodial arrangements executed by intermediaries. Every coin gathered before a reset becomes a lever the government can later pull. Because this phase, the silent accumulation, isn't about making a profit. It's about positioning the U.S. to do exactly what Roosevelt did with gold. Change the price of the asset they control, and rewrite their balance sheet with a single announcement. That's where the revaluation begins. Once the U.S. has accumulated enough Bitcoin, the playbook shifts. Phase 1 is acquisition. Phase 2 is repricing. Here's how it works. Bitcoin's market value is whatever the global market says it is, until a government with massive reserves decides otherwise. If the U.S. quietly amasses 1 million Bitcoin, they immediately become the largest single holder on Earth. And when you're the largest holder, you don't follow the price. You set the floor. The reset begins with a single declaration that Bitcoin, for strategic reserve purposes, will be valued not at $100,000, but at a strategic price, $500,000, $700,000, even $1 million per coin. Not a market prediction, a policy decision. That one move rewrites the government's balance sheet overnight, turning a $120 billion acquisition into hundreds of billions, or even $1 trillion, in declared value. And once the U.S. publishes that price, the market doesn't ignore it. It gravitates toward it, just like gold did after 1934. A repricing cascade follows: $300,000, $500,000, $800,000, until the strategic valuation becomes reality. But here's the part nobody connects. Every upward move in Bitcoin is a downward move in the dollar. The revaluation of crypto is the devaluation of the currency it's measured against. Bitcoin is the lever for the future, but to reshape the financial system today, the government needs an asset with history, credibility, and global legitimacy. That asset is gold. On paper, the United States holds 8,133 tons of it, the largest official stockpile on Earth. But here's the part almost no one notices. On the federal balance sheet, that gold is still recorded at $42.22 per ounce, not at $2,800 where the market trades, not at the bullish forecasts analysts keep promoting, at $42, a statutory relic from the early 1970s. That's not an accounting oversight, that's intentional headroom. As long as gold is booked at $42, any official revaluation instantly creates trillions in new balance sheet strength, without mining, without purchases, without spending a single dollar. Here's how the play unfolds. Gold will no longer be valued at $42, nor at the current market price, but at $15,000 to $20,000 per ounce. In one move, the nation's gold holdings leap from roughly $11 billion on paper to multi-trillion-dollar territory. No new assets, no new production, just a recalibration of an asset the government already owns. And combined with a strategic Bitcoin revaluation, this becomes the backbone of the debt erasure mechanism. Assets surge, liabilities shrink in real terms. But the shockwave doesn't hit citizens immediately. The real damage arrives next, when the dollar begins to buckle under the weight of these revaluations. Gold and Bitcoin revaluation doesn't happen in a vacuum. Every dollar-denominated asset, savings, wages, retirement accounts, bonds, gets dragged into the blast zone. When the government marks gold at $15,000 or Bitcoin at $1 million, they're not just boosting their reserves. They're redefining what the dollar itself is worth. If a hard asset jumps 5-fold, 10-fold, the currency measured against it doesn't stay still. It collapses in relative value. And that collapse hits ordinary Americans first. Suddenly, a dollar that used to buy a basket of groceries buys half. Rents surge, energy costs explode, food becomes a larger share of every paycheck. Nominal prices rise, but real purchasing power sinks fast. You don't see a "we're devaluing the dollar" announcement. You see inflation numbers that always underestimate reality. You see wages that never catch up. You see savings accounts that look the same on paper but buy less every month. This is how governments erase debt without touching the principal. ripple by letting currency deterioration do the heavy lifting. For Washington, it's a reset. For citizens, it's a slow-motion confiscation. And globally, the rest of the world isn't standing still. They're preparing for what comes next. The U.S. isn't operating in isolation. Every major economy is facing its own version of the same math. Too much debt, too little growth, no political appetite for pain. And while Washington moves toward a quiet reset, other nations are positioning themselves for the fallout. The BRICS bloc, Brazil, Russia, India, China, South Africa, has spent years building an alternative architecture to the dollar, not rhetoric, action. China has been stockpiling thousands of tons of gold, far beyond what it reports officially. Russia shifted aggressively into bullion long before sanctions hit. India is buying at record pace. These countries aren't guessing. They're preparing for a world where currencies are repriced and hard assets become the anchor of monetary power. So when the U.S. executes its reset, the ripple won't be national, it will be global. And that's why the next phase isn't financial forecasting, it's a timeline. A monetary reset isn't a single event, it's a sequence, one phase setting the stage for the next. And right now, the pieces are lining up with alarming precision. 2025, the accumulation phase. This year is about preparation, not announcement. The U.S. quietly expands its Bitcoin holdings through seizures, settlements, and discrete acquisitions. Gold remains steady on paper, but Washington begins floating language about sound money, strategic reserves, and restoring monetary stability. It's narrative formation, the soft groundwork that makes radical policy seem reasonable later. Meanwhile, volatility rises. Bond markets twitch. Yields drift upward. Nothing breaks outright, but stress becomes visible. 2026, the crisis window. This is the catalyst year. Debt ceiling negotiations turn hostile. Government shutdowns become real threats. Treasury auctions weaken. Investors demand higher yields, pushing the system closer to fracture. A crisis, any crisis, gives policymakers political cover to do what would be unthinkable in normal times. They'll frame extraordinary actions as protecting stability and defending the dollar, even as those actions set the stage for its revaluation. This is the justification phase. 2027, the revaluation shock. This is where everything accelerates. The U.S. reveals the completed strategic Bitcoin reserve. They declare an official valuation dramatically above market levels, a new anchor price. Simultaneously, they unveil a partial gold-backed framework, accompanied by a massive gold revaluation. Bitcoin shoots upward. Gold surges. The dollar's real purchasing power falls sharply. Government debt, still $37 trillion on paper, but now dramatically smaller in real terms. 2028, the stabilization period, markets settle into the new reality. Hard assets plateau at elevated levels. The dollar stabilizes at a lower value. The reset is complete, and the winners and losers become impossible to ignore. A reset of this scale doesn't treat everyone equally. It creates a divide so sharp that two groups emerge almost instantly, those who benefit from the revaluation and those who get crushed by it. The winners, the U.S. government. It eliminates trillions in real debt burden without defaulting. On paper, the numbers stay the same. In reality, the weight evaporates. Early Bitcoin and gold holders. Anyone who owned hard assets before the revaluation sees their purchasing power multiply. Volatility is painful, but the payoff is enormous. Foreign governments with large gold reserves. China, Russia, India, their bullion skyrockets in value. Their own debts shrink in real terms, mirroring the U.S. playbook. The wealthy and institutional investors, real estate, equities, hard assets, they all inflate nominally. The rich stay rich because their assets adjust with the reset. The losers savers, they hold dollars. Dollars lose value. It's that simple and that brutal. Bondholders and pension funds, fixed income instruments collapse in real terms. They get repaid, but in devalued currency. Workers and renters, wages lag behind inflation. Rents surge. Living standards fall sharply. The middle class, their savings dissolve. Their costs rise. Their financial security evaporates. This isn't theoretical. This is the predictable fallout of every major devaluation in modern history. If you wait for an official announcement, you're already too late. Resets don't reward those who react. They reward those who prepare. Here's what positioning yourself actually looks like. 1. Exit dollar-denominated traps. Bonds, long-term treasuries, corporate debt, all of them collapse in real terms during a devaluation. They'll repay you, yes, but in dollars worth far less than the ones you invested. Hold only minimal operational cash. 3 months of expenses at most. Anything more becomes collateral damage. 2. Shift into hard assets. Physical gold. Not paper claims, not ETFs, the metal itself, Bitcoin. If you understand custody and can secure it, it will be volatile, but volatility is the price of asymmetric upside. Productive real estate, farmland, rentals in stable regions, anything tied to essentials rather than speculation. Energy and commodity exposure. the things that inflate first and fastest during resets. 3. Manage your debt carefully. Low-rate, fixed mortgages can be an advantage. High-interest or adjustable debt becomes a trap. If your income can't keep pace with inflation, debt stops being leverage and starts being quicksand. 4. Diversify internationally. Don't keep all your savings confined to one currency or jurisdiction. Foreign accounts, foreign property, foreign income streams. Optionality is protection. These steps aren't theory, they're survival mechanics. The same strategies used by every country, family, and investor who lived through a major currency reset and came out intact. At this point, the reset may sound extreme. It may sound dramatic, but here's the truth. None of this is speculation. It's arithmetic, history, and political reality converging. Start with the math. A debt-to-GDP ratio of 132% is not sustainable. Annual interest payments over $1.2 trillion are not sustainable. A trajectory leading to $1.8 trillion in interest by 2027 is not sustainable. These aren't forecasts. These are official government numbers. Now add the political layer. No administration, left or right, is willing to slash spending deeply enough. No Congress is willing to raise taxes enough. No voter base will tolerate cuts to Social Security, Medicare, or defense. And no central bank can raise rates high enough to fix the issue without detonating the economy. When all traditional paths are blocked, only one option remains: devalue the currency that the debt is denominated in. And history shows the pattern clearly. Weimar Germany did it. Argentina did it multiple times. Zimbabwe did it. Venezuela did it. The United States itself did it in 1933. Every nation backed into a debt corner chooses the same escape route: inflate away the obligations and shift the cost onto savers. There has never been a single exception, because the alternative is political suicide. This isn't a what if, it's a when. And before we close, you need to understand exactly what the next 2 years will look like for anyone holding dollars. Over the next 2 years, the reset won't look like a single dramatic moment. It will look like a series of normal headlines: inflation that's unexpected, bond yields that surprised analysts, market volatility blamed on geopolitical tensions. But beneath all the noise, the mechanism will already be in motion. Bitcoin drifting upward, then surging. Gold breaking through ceilings nobody thought possible. The dollar weakening in a pattern that economists will call temporary, technical, or transitory, even as purchasing power quietly evaporates. And then one day, the numbers won't go back. They'll settle into a new reality, where the government's balance sheet looks healthier, but ordinary Americans feel poorer than they've ever been. This is not chaos. It's not an accident. It's not mismanagement. It's policy. Deliberate policy designed to protect the institutions in power at the expense of the citizens who trust them. And that's why your next move matters more than any headline. You can ignore the signals, hold your savings in dollars, trust that stability will magically return, and watch your real wealth erode year after year. Or you can prepare now. Shift into hard assets. Diversify. Protect your purchasing power. Make decisions future you will thank you for. Because once the reset completes, there is no rewinding it, no appeal, no warning siren, only the aftermath. If this breakdown changed the way you see the next 2 years, don't navigate it alone. Stay ahead, track the signals, and position yourself before the window closes. The reset is coming, and the only question left is the one that determines your future. Which side of it will you be on?